Hey there, Nathan Soliday with nathансoliday.com. And I wanted to put together a short video this afternoon on the basics of the FHA loan program. A lot of times the FHA program is one that is misunderstood by a lot of people, whether it's a home buyer that doesn't quite understand it, or a home seller, or even a real estate agent. But with an FHA loan, it can definitely be a great option to be able to buy a house, and there are a lot of really nice benefits to that program as well. And we're going to go over a few of those here in just a few moments. But before I do that, if you have any questions about the program, or if you watch the video and you'd like to see if you can qualify, feel free to reach out to us. I've got my contact information below. You can feel free to text us, call us, send me an email, and that type thing. And you can also take our free homebuyer quiz. I've got a link for that as well. It'll take you about 60 seconds to go through that. It's really easy. You don't have to put in your credit information or social security number or anything like that. But if you do the homebuyer quiz, we can take a quick look at that and see if we can point you in the right direction on, if you can qualify for an FHA loan now, or maybe in 90 days or 180 days, or if there's another program that may work a little better for you. So we can talk about those things, if you have any questions along those lines. So we'd definitely love to help with that. So let's get started with the FHA Loan Basics. So one thing about an FHA loan is it's a government program. And, whether you like the government or not, it's a great program that's out there. It's put in place by the Department of Housing and Urban Development, and since it's backed by the government, it allows you to have some really good, strong interest rates, which is very important in a time like this. So, a lot of people kind of have the misconception that, oh, FHA is going to be a more expensive program, the interest rates are going to be crazy high and things like that, but it doesn't have to be. And so one of those places where that starts when it comes to your overall payment, when it starts with a loan, is obviously your interest rates. And with FHA being backed by the government, it definitely is a benefit from that standpoint, especially when you compare an FHA loan to a conventional loan with a lower down payment. You'll see that the FHA program typically has lower interest rates than that. Now, it could be a little different if your credit scores are lower and that type thing, and we can always look at comparing both of those. But on the from a majority standpoint, the FHA program does have good interest rates there. So keep that in mind. Also, one thing that works out well with an FHA loan is you can actually have a lower credit score and qualify. So with a conventional program or like a Fannie Mae, conforming loan and that type thing, typically you're going to need a 620 score, but a lot of banks out there are going to require you to have a 640, a 660, 680, and that's not to mention the big down payment that they may require. But FHA will actually go down lower than a 580, but for our company, we require that 580 credit score, to begin to start looking to see if you can get qualified. And a good way to know what your credit scores are is you can use some different apps like the Credit Karma app or things like that, to kind of get an idea of where your scores are. But a lot of times we've seen that the Credit Karma app is usually about 30 points higher than what an actual mortgage score is, because it's a different scoring model. So if you've got a Credit Karma app and you see your scores are in the 610 or 620 range, then you may be able to qualify for a house, with the FHA program. So keep that in mind. So if your credit scores are a little lower, don't let that scare you. There still may be some options for you to be able to qualify with that. The really nice part of the FHA loan is that it requires a low down payment. So a 3.5% down payment is the minimum that FHA requires. You can do a bigger down payment if you'd like, but the FHA program is set up so you can actually buy a home with a small down payment. So for example, if you're looking at a house in let's say a $200,000 range, you'd be looking at basically a down payment of $7,000. You're going to have closing costs with that, but a seller can pay your closing cost for you. So depending on, what kind of market that you're in or how flexible your seller may be, they could actually give you a credit for your closing costs, which could keep you in that 3.5% down payment range. So that's something we can talk about if that's something that you're interested in. But the down payment part of the FHA is one of the large benefits of being able to buy a house. And With a conventional loan, you can buy with a low down payment as well. A lot of times 3 or 5% down. But like I mentioned earlier, sometimes you have to have 20% down with certain lenders. With FHA, you don't have to do that. You can do the smaller down payment, and if your lender doesn't offer an FHA loan, or bank, definitely try to find one that does. If you're not going to qualify with that certain lender that you've been talking to, because there are a lot of options out there. So 3.5% down payment can be a great option for a FHA loan. The nice thing too is if you don't have the down payment from an asset standpoint in your checking account or your savings account, you can also borrow from your 401k or take out your 401k to use as a down payment. Obviously, that's not going to be your first choice. You want to be sure that you're preparing for the future as well. But it can be an option if you're in a situation where you're wanting to buy and you've got some funds, but you don't want to use all of that for your down payment, and you think, hey, I can use a little bit of my 401k, to put towards a house, then that's definitely an option. Everybody's going to look at that option differently, but if that's something that you want to do, it is definitely available, with FHA there. So keep that in mind. Another thing that works well from a down payment standpoint is if you don't have the 3.5% down payment. So, like I mentioned, the $200,000 house, 3.5% down payment would be $7,000. If you don't have that in your account, you don't have that saved yet. Maybe you don't have a 401k, or you can't access your retirement funds, at this time. You can also actually get your down payment as a gift. And now, the gift needs to be typically from a family member. But let's say if you have a parent that would like to, help you buy your first house or help you buy a home, and they've got some money that they would like to, gift you in that way, then that can work out to be a very good way to actually come up with your down payment. So in that situation, it's really a no money down program when it comes to your down payment, because you would be getting a gift from a family member. Now, if they're not a family member, that can be a little more tricky. It kind of depends on the situation, but that's something we could look at too if you have a question, about something like that. But gift funds can be a great source of a down payment when you're thinking about buying a house. One of the final ways that FHA basically says yes or no to a loan is they're going to look at your debt ratio, and where you are from a debt standpoint. FHA has the most flexible guidelines when it comes to debt ratios. They'll allow you actually to go up to 56% of your income to qualify for a house. Now, what a debt ratio is, that's basically a combination of all of your, fixed monthly payments that you have now that basically show in your credit. So, for example, your minimum credit card payments, any car loans that you have, any other credit cards or anything like that shows up on credit. Basically, that's going to play into this debt ratio, and then you also add your house payment into that, as a total, and then you actually divide that by the amount of gross income that you have on a monthly basis. Now, 56% is a very aggressive debt ratio requirement, and you may not want to go that high on your debt ratio. But where this can come in handy is for example, if maybe you're buying the home with a spouse, or with another person, and maybe their credit isn't quite good enough, but you have their income, that comes into the household, monthly or weekly. What can happen in that situation is, with that flexible debt ratio requirement, your income may be, you may be okay going up to 56%, as long as the spouse has more income to add to that, which would give your overall household debt ratio a lower percentage. So you don't want to max out what you can, what your household has, as far as maxing out with the very top limit on a house. But it does give you that, flexibility to be able to go up higher. And some other programs won't allow that. So a lot of times a bank will, basically say, hey, you can't go over 41% of your debt ratio and qualify. And when that happens, that, limits you on what you can buy on the house. But, in reality, you may have extra income coming in that's not getting counted toward that ratio. So it's definitely something to keep in mind there. Again, it's just more flexibility with the FHA loan than a lot of other programs have. And then finally, fast closing turn times. So, for example, FHA loans don't have to take much longer than a regular conventional loan. Sometimes the appraisal can take a few days longer. It just depends on your market, but typically we close these in 21 to 30 days. And we'd love to help you, try to buy a house in that timeline. So hopefully this is helpful. Feel free to check out the links below the video. Let us know any questions that you might have. We've got a team here that would love to help. I'm happy to help in any way that we can, and hopefully we can get you into a house in the very near future. So thanks for watching, and we'll talk to you soon.